we have a record percentage of consumers that are dining on a deal right now, close to 30%, which is actually the highest number ever recorded as far as I know. And now we've got McDonald's sort of upping the ante, so to speak, by actually lowering prices. It's not, I mean, we could debate how much they're actually lowering prices, somewhere in the 5% range, but you know what? Restaurant chains just don't do that. A very few businesses ever do that. We're doing all of that, and yet we are still talking about a slowing environment. This has got to be one of the more weirdly stubborn consumer environments that I ever recall. What is the state of the restaurant industry right now? Hello, I'm Jonathan Mays, editor-in-chief of Restaurant Business, and in this week's episode of A Deeper Dive, I speak with Rich Shank, my colleague at Technomic, about that very subject. And it is a really good question. While the stock market continues to thrive and certain segments of the restaurant industry are busy, a lot of other data suggests that operators have a lot to worry about right now. So I had Rich on to talk about how all this affects the restaurant industry. We talk about Technomic's forecast and why improving results in the summer appear to have given way to more weakness. We talk about why consumers are ordering so many discounts and how those discounts have changed compared with the last time we had this level of discount shopping. We also talk extensively about Starbucks and what's behind its weakness. This is a great episode on the state of the restaurant industry today, so please check it out. Okay, I'm here with Rich Shank. Rich, welcome to the podcast.
Thanks for having me again.
So, this year hasn't quite turned out the way we thought it was going to turn out. What's your kind of assessment of the state of the industry right now?
Sure. I think there's a lot of spottiness in performance, right? So, and it's very uneven across the industry. We had started feeling pretty good about, recovering from that February and March lull, because we had seen traffic improvements through July. Our forecasts through October show tapering off of that, but we're seeing some clear signs that, with consumer confidence spiking, the last labor report from ADP, which is our only signal right now, not looking good. The potential for layoffs as people start looking at their 2026 budgets coming up here soon, are, I think, all looming, over top of what our next reporting period is going to look like.
So you're expecting a slowdown in sales for the balance of the year, or just for October?
I would expect it to. We're the only thing that's really in our favor is trying to lapping some already negative numbers in 2024 at this time of year. So, we could potentially look like growth, but still not feel good about it. And so, I would expect there are signs of pretty clear risk, right? I think the signals that we were seeing in summertime, where we thought maybe some things were behind us, the uncertainty about what was going on with tariffs, then they were implemented, and those numbers are starting to come in right now. So, right when we got that momentum back, tariffs went into effect, and we're starting to see their influence on not necessarily restaurant pricing outright, but pricing in the market overall, which impacts our customers and their ability to spend at our stores.
Right. The thing is, you talk about comparisons though. We've had weak traffic for 2 years now, 2+ years.
Yep.
The fact of the matter is that this weak traffic, high value marketing period has been ongoing for, close to 2 years, I think. I think if we got to go back to really the beginning of 24. The thing that I'm just kind of stunned by all of this is we've had, over the past 2 years, we've got a record number of limited time offers, according to you guys. So record LTOs, and at least some of that is social media, but that a lot of that is simply because restaurant chains are just throwing everything they can at a wall to see what sticks. We have a record percentage of consumers that are dining on a deal right now, close to 30%, which is actually the highest number ever recorded as far as I know. And of course, you have all of these value offers. And now we've got McDonald's sort of upping the ante, so to speak, by lowering prices.
Mhm.
It's not, I mean, we could debate how much they're actually lowering prices, somewhere in the 5% range, but you know what? Restaurant chains just don't do that.
Right.
Very few businesses ever do that. We're doing all of that, and yet we are still talking about a slowing environment. This has got to be one of the more weirdly stubborn consumer environments that I ever recall.
Yeah. I mean, there's a lot of things unprecedented happening in the market right now that are hard to measure too, that don't really factor into the numbers. You see the news in Chicago where I live. It's really hard to understand how that influences, impacts our clients, right? In specific neighborhoods, there's got to be we know there's a slowdown happening because of just activities in those neighborhoods, right? So there's things we can't measure. That's really weighing on people. Tariffs are weighing on people. The divisive nature of our politics are weighing on people, and it's it's showing up in consumer confidence numbers, and it's just it's taking away from what we expected to happen this year, because inflation was cooling to the point where it looked like historically normal price increases happening at the end of 2024, and that in Q2 went away. Of this year, we're back to where we were in 2023 almost. And if it continues that way, it'll be right where we were at in 2023 in terms of price increases, which is why we were in the predicament we were in 2024. And that's why all those deals went into the market. The one thing I'll say about that 30% number is the definition of a deal is very different today than in 2008. And it expands beyond discounts, because you have all those loyalty rewards that then they offer discounts. You have everyday value meals that kind of factor into those numbers. And, so it's a very expansive definition of what a deal is right now, because people are looking. I mean, we knew traffic would be constrained just because and we've talked about this 100 times about just demographics not being in our favor to grow naturally, significantly anyway. And so we knew that everything was going to be about stealing share beforehand, but I don't think anyone anticipated the mood being this negative, generally speaking. And it's really impacting the way people dine out, and they're worried about their pocketbooks, so they're dining on deals. And dining on deals may not necessarily mean, pulling out the coupon. One thing we've seen is like fine dining traffic in our tracker is not unhealthy. It's not great. But what is strange about the numbers is the way that they're managing check, because average check growth in fine dining is barely 1%. Almost all their dollars are flowing in from traffic. And that means that people that are actually going to those high-end restaurants, even at the upper end of the market, are really managing their checks. And, they may be skipping an adult beverage. They may be not ordering that side or appetizer instead, but they're still going out for the experience, but they're worried about their pocketbook, even at the high end of the market.
So they're a little concerned. That's probably what we would put it. They're a little concerned. They're a little concerned about the future, so they're budgeting a little bit, but they're still going out, which kind of fits that whole, because like right now we have a bifurcated market. And so you do have a number of consumers feeling perfectly fine.
Yes.
And then you have a large swath of consumers that are not.
Well, I mean, the one thing that's interesting to me, and we talk about the bifurcated market, right? And, you start thinking about who the biggest pool of customers are. It's the people in the middle, generally speaking, right? And their moods are definitely dire compared to where they were a year and a half ago. But the thing that we've seen are the brands that are actually winning traffic today are actually expanding their share of business with middle-class consumers. And they're doing it by being able to compete on affordability, but doing it in a way that provides excitement and value. Like the Chili's story is a perfect example. The story of Starbucks on the other end of this spectrum, they've expanded their customer base to the proportion of their visits that come from higher end consumers expanded over the last 2 years. And they've not won traffic, right? They've actually lost traffic. And when you look at the companies that are in their market that are actually growing right now, they tend to do better with middle-class consumers. They're actually expanding that customer base as a share of their business. And so they're not necessarily bypassing that bifurcated market because middle-class consumers are impacted by it, but that's where they're winning traffic right now, is in the middle. because that's the biggest pool of customers available to us. It's a really tough, challenging proposition to do that, but that's who's winning today, or any brand that can expand their middle class base.
Yeah. Yeah, let's take a look at that Starbucks example, because I think that if I look at any restaurant chain right now, that just really puzzles me to the nth degree. It really is Starbucks, because I think they almost went from doing exceptionally well to doing not exceptionally well in a absolute blink of an eye, really fast. And I remember at the time thinking, well, like, okay, you would have all these people wondering what's going on at Starbucks, and they would complain about, the treatment of customers inside the coffee shops, and, the backups because of mobile ordering, price-based issues, and, whatever excuse about Starbucks operations. And my response to that was always something along the lines of, well, that can't be the case, because it happened relatively suddenly. It happened in roughly late November of 23, when their sales immediately just fell. It just went off a cliff.
Yeah.
And they haven't been able to recover. I mean, we're 2 years into this now. It's a weird situation, and I think that what you bring up is an issue that I think the biggest concern that I have with Starbucks is that it has lost its reputation with the younger consumer, with younger consumers who would go to Starbucks for all of these weird customizable cold beverages. And these consumers have many other options, and they just don't go there as much anymore as they used to. It's almost as if they lost a certain number of consumers.
Well, if you look at their age composition, I mean, they were a brand built on baby boomer demand, right? Over the course, and Gen X a little bit, like, there's not enough of us Gen Xers for people to really care, but the baby boomers in particular were a huge part of their growth story. The fact that they're not winning on those sort of more jazzier customization type beverages is a big important part of the story, because they continue to rely heavily on those older consumers. And if you look at how they're positioned compared to, say, a Dutch Bros or a Seven Brew or Scooters or any of these other brands that are providing these more modern beverages, if you will, the one thing that's very interesting about the distinction between those brands and Starbucks is Starbucks still relied pretty heavily on a everyday coffee consumer. And as their boomer folks continue to age and they continue to retire, those everyday coffee occasions go away. They're not commuting. There's no reason for them to pick up a coffee in the morning anymore, right? And so, in the beverage space, we're talking about late morning, early afternoon drinks for this crowd that's driving growth in the beverage category. So that's one thing. I do think the story about their operations is an important one, but it's not the only one. The other thing that's unique in this environment, when Starbucks was growing dramatically, their strategy was to surround mom and pop restaurants, right? And they were able to win traffic through their service model. And, there was, in the 90s when I was growing up, that was a bit controversial. People didn't like it, but they won that battle. And now it's inverted, where they're being surrounded by all these emerging brands. And so now there are these choices out there that are a little bit more attractive to younger consumers. They are the ones being surrounded by their competitors. They're really having to think through, what that next stage is, because it's not just about the comfort in the environment. It's going to have to be, how do you win back those younger consumers as well? And can you do it in a way that is unique from the path that's already been won, right? Dutch Bros and Seven Brew are already sort of taking that path over, essentially.
Yeah. Yeah. Quietly, one of the biggest metrics that I think tells you that story about Starbucks is actually, oddly enough, Piper Sandler twice a year does their Taking Stock of Teens survey. Starbucks is always, and it's always an interesting survey to get like some sort of idea of what teens are thinking. But really, not much change from one year to the next. Actually, they do it twice a year. And suddenly, a couple of years ago, Starbucks fell off that list. They used to be one of the top 2 restaurant chains that teens preferred, and then they just kind of fell off the list. And to me, if you think about all the places that you can go if you want some exciting new beverage today,
Right.
you have so many locations. You go to a mall and you can get there are 3 or 4 places where you can get boba tea from. You can go to you just you have this endless list of concepts that you can go to get a beverage from. And to me, like if Starbucks is going to regain its former sales, getting that customer base, because you still do want to get younger consumers, and
Yeah.
younger consumers were going to Starbucks at en masse for a long time,
Yeah.
and now they are
And
not.
and I'm wondering, if you think about who they were at their core, and this is something that's a little bit more speculative on my part, but a lot of those younger consumers were going in with their parents, and or were ordering off of their parents' app, and things of that nature. And at some point, as you age into your teen life, you try to become someone a little different than your parents, and that there may be a risk of like that's mom and dad's place in that. And that's, I mean, that's happened to other brands before, in their kind of historical arc. And this is the risk that they're sitting at right now, is if they can't figure out how to reinvent themselves. And it'll be challenging because, to your point, there are just so many options out there that can be facilitated through some very authentic menuing, and it's hard for a brand like Starbucks to own that space when they've been something else for so long.
Now, one of the biggest concerns today, and we've seen this for a while, and you mentioned it briefly, is the issue with the Hispanic or Latino consumer. We have some data, and we have some restaurant chains. In fact, Jack in the Box will basically explicitly tell you, Wingstop to a lesser extent, but Jack in the Box will tell you that the Hispanic market is weak. And then if you look at where Jack in the Box is, Jack in the Box, by the way, they did negative 7.1% same store sales. They have not done as you would think that Jack in the Box during the pandemic did some worse number. They haven't done that bad since 2010. That was pretty brutal. And they were specifically mentioning the Hispanic market. We have Wingstop, has seen sales slow down for the first time really in a while. Do you have any sense or data to highlight the issues with that market?
So we've been looking, and we're currently in the process of normalizing a whole data set of transactions at the local level. So we're not fully there on the analysis we want to do, but the easy sort of story there is when you start looking at counties and cities that are heavily Hispanic, and even at state level trends, it's certainly showing up in the numbers. You can isolate, the Rio Grande Valley, and I know Walmart's called this out in their own retail sales earlier in the year, that it was certainly not looking great. If you're worried about what's going on, the first thing you're going to do is not go out in public. You're not going to stand in line to get food. You might have it delivered to you, maybe, but the frequency with which you can do that is, in certain markets, it's pretty challenging, especially in smaller cities and towns. And, so that's definitely shown up in the numbers. And we've seen that with some of our custom research that we've done with our clients. They've seen similar things that Jack in the Box has seen. They just maybe not have been as exposed to it, because your footprint really could overexpose you to this issue, depending on how penetrated you are in different markets. And Jack in the Box being where they are, obviously, I think have a pretty, and again, also their menu lends itself to being a focus of that target. And that was an important marketing target for them for years too, right? So they were trying to grow business with them, and it's getting cut out from under them.
Right. Well, Jack in the Box as a chain is kind of easy because they have a lot of, their locations are basically in California and Texas.
Right.
They have, a few states here and there outside of that, but on balance, it's a California and Texas chain.
Yeah.
And obviously, and then, some Arizona, et cetera, et cetera. So they are, you could definitely see where that would happen. But I think it's worth pointing out, and you pointing out some, maybe some areas in Chicago, stuff like that. You have a lot of, say, smaller markets in the Midwest, out east, and places like that have become, areas where a lot of Hispanic consumers have settled. And so it's not just those markets in the Southwest. I mean, it's you do see in other pockets of the United States, like rural Missouri or rural Kansas and places like that. We
Exactly.
have heard from operators that they have had issues finding labor in some of these markets and in generating sales in some of these markets, because of that.
A lot of these places are getting their population growth or were from immigration before. So, you're taking a natural growth lever out of the equation for these smaller markets that they could have relied on before. So in addition to, people who are living there now being somewhat fearful to dine out, the people aren't moving there. The population growth we saw last year is going to be effectively zero. And that doesn't lend well for 3 to 4 years from now when we're trying to find growth, when all those kids age into buying Happy Meals and, kids meals and other things like that.
Yeah. Well, yeah, broadly speaking, I think that we're going to have a population issue going forward, absent immigration. And then that has all kinds of implications. And for the restaurant industry, population growth has been basically fueling pretty much all of the industry's growth in recent years.
We estimated it a couple of years ago as best we could, and it would look, based on the numbers, it's around 70% of real growth was due to population increases. That's not going to be there anymore.
Right.
It's going to have to reset our growth expectations overall, and it does factor into our forecasts. I mean, our forecasts aren't historically strong going even into the next 5 years just because of that.
Yeah. I mean, fundamentally, restaurants need people. And if you don't have as many people, that's pretty simple.
We've gotten to the point where as soon as momentum happens, something happens to just cut it out, right? And so whether it's the immigration story, the tariff story, that's going to start impacting, the labor market here, I think, coming into the next few weeks or months. Just if this ADP number holds up and it starts to look like that every month for the next couple of months, it's not, it's really going to change the way the end of the year looks. And we're already looking at about a negative 1% traffic overall system wide.
Yeah. All right. Well, I mean, yeah. I mean, I suppose the good news about a weak overall market is that you won't have to worry about a labor shortage if the labor market continues to get weak. I want to ask before we go, I wanted to go back to a point that you had made on dining on a deal, because I think that's one of the more interesting facts of today. Because right now, because you pointed this out, what a deal looks like in the restaurant industry today is very different than it was back in 2008, when the industry went through a massive downward shift in the price that consumers were willing to pay to eat out. And like right now, I don't think the deals, to me, I don't think the deals themselves, for the most part, are as aggressive as they were back then. But it seems that there's a broader set of deals. Like you can get it anywhere. You can go on delivery apps and you can get a deal, which still blows my mind, even though I know why it happens. You have mobile apps, have basically, for what it is worth, the mobile app has basically replaced the paper coupon.
Right.
For the most part. And then you have broad deals. What kind of deals people are looking for, or what kind of deals are out there, have just really changed.
Yeah. And I don't even know if consumers know what they're looking for exactly when it's not something on the core menu, just because the diversification of loyalty programs and the way those deals flow through and how different they are from app to app, especially if you're looking at branded apps, like restaurant branded apps, they can be very different. And so it's hard to know what's actually working overall. I mean, people are coming into it, but what's creating incremental business, right, is I think a hard thing to know right now. And just because of how diverse they are. I know in my own personal life, I'm really keen on the brands that give me like $10 off every $100 I spend. And it's very predictable for me to know what that looks like. And I tend to, go to them very often. But for someone else who maybe works through the McDonald's app and they're used to getting freebies every now and then, that doesn't work for every brand. right? Like, and so not every brand can do that. So when they go into the next app, it looks different. So, what's really causing them to change their behavior, or whether it leads to an incremental trip or not, is really hard to know at this moment. So that's the only the point I was making earlier was just like the diversity of the deals unprecedented, and how you even define it today is hard to know sometimes too, because like what you're talking about on the third party apps, it may actually be more expensive than if you went inside the store.
Well, for sure. Yeah. Yeah. Well, let's
Even
not,
though it was a deal.
let's not make that mistake. Yeah. If you're buying delivery, you're paying more, period. You're definitely paying a lot more than you would otherwise, but you still see like free delivery, discounts, and then some chains. I've talked with a number of franchisees.
So one thing I can say, recently we did a project where we were looking at what consumers are willing to spend, breakfast, lunch, dinner type stuff. And what they defined as a good value in terms of the overall value dollar hadn't changed in the last couple of years. It didn't go up. But what, the things that they thought were premium and were worth something that was of high quality went up about 10% ish. Right. And so they were, like, people are willing to spend a little bit on something they think is great. But if you're able to offer it in a way that is perceived as a great value or a good deal, it's probably going to be the best winner that you can find. Like Chili's is the perfect example of that. I just saw them promoting their instead of the smasher burger, it's the QC, it's the quarter pounder at that $10.99 price point. I mean, it's good enough. It's actually falls well under the threshold of what people are willing to spend at dinner. That's the kind of deal people are, I think, gravitating towards right now. As long as if it's good enough and justifies the price point, it's still driving traffic, but there's a lot of noise out there just because the volume of deals has gone up so much.
Right. I think that is a great spot to end. Rich, thanks for joining me this week on the podcast.
Not a problem. Thanks for having me again. It's good to talk to you.
And that should do it for this week's episode of A Deeper Dive, which was edited, as always, by Spoons, artwork by Nico Hines. You can find this and other episodes of the podcast on our website at restaurantbusinessonline.com/article/deeper-dive. But by all means, subscribe on Apple Podcasts or Spotify. I'm Jonathan Mays, your host, podcast producer, and the editor-in-chief of Restaurant Business. Thank you for listening.